30-year mortgages require both principal and interest payments every month. So that means that a portion of your payment goes towards paying interest and another portion of your payment goes towards paying the principal balance down. These are called P&I payments, principal and interest payments. Interest-only loans are different from 30-year mortgages because you are only making interest payments on the loan. You are not making a payment every month towards the principal. This means that your monthly payment is a lot lower with an interest-only payment. And why would that be a benefit to you? Well, if you're not taking money and paying it towards the principal of the loan every month, that means you have more money. And you can use that money to reinvest, or you can use that money to make repairs or improvements to the property. An interest-only loan is not meant to replace a 30-year mortgage. You only want to use an interest-only loan for short-term loan needs, anything under 5 years. So if you think you're going to have a loan for 5 years or less, an interest-only loan may be a good option for you. For example, let's say you purchase a property and you put a really large down payment down on that purchase. You've already paid the principal down. So if you're only going to hold that loan for 5 years or less, why make principal payments when you've already paid the principal down with the down payment? Take that extra money that you'd be using every month to pay towards the principal and use it in other areas, such as those that I already gave you. What are some other examples where an interest-only loan may be a good fit? For real estate investors that are looking to purchase properties to flip or to rent, they're only going to need that loan for a year or less. So why make principal payments if you're only going to hold that loan for such a short amount of time? Just making interest-only payments would lower your monthly payment, and that way you can take that extra money and use it. For example, a real estate investor would use it in repairs or improvements to that property. Another example, if you're getting a short-term bridge loan to purchase a new home while you're waiting for your current home to sell, this is a good example where you're only going to have a loan for a year or less. So you'd be better off just making interest-only monthly payments rather than principal and interest payments. And then finally, another good example is, let's say you're in a high interest rate environment where the prime interest rate is super high. If you're making a real estate purchase in a period where the interest rates are super high, you'd be better off getting an interest-only loan and then paying just the interest on that loan every month to keep your loan payment as low as possible. And then when interest rates go back down, you can refinance with a 30-year mortgage. There are definitely certain situations where an interest-only loan would be a way better fit for you or someone that you know. And if you know somebody that doesn't understand how interest-only loans work, share this video with them. And if you liked this, like, and if you want to see more videos like this, subscribe to my channel.